What if I told you the stock market hit all-time highs while a war was actively being fought? No, I'm not making that up. And no, the financial media didn't explain why. So let me. Let's be real for a second. If you watched the news in April, you saw the same recycled headline, "Markets rally on ceasefire hopes." Clean, simple, easy to digest. And completely wrong. Because here's what they didn't tell you. The Strait of Hormuz was still 96% shut down when the market exploded. Oil was still disrupted. The war wasn't over. But the S&P 500? Up. The Nasdaq? Up. The Dow had its single best day in nearly a year. So if it wasn't peace that moved the market, what did? Stick with me for the next few minutes, because what actually happened is one of the most important things you can understand about how modern markets really work. And by the end of this video, you'll see financial news completely differently. To understand the explosion, you need to understand the pressure building underneath. Let's rewind to February 28th. The US and Israel launched joint airstrikes on Iran. Supreme Leader Khamenei was killed, and Iran responded by doing something that sent shockwaves through every trading floor on Wall Street. They shut down the Strait of Hormuz. For context, roughly 20% of the world's oil passes through that strait every single day. Over the next 5 weeks, the S&P 500 dropped nearly 9%. Retirement accounts quietly bled out. And underneath the surface, something even bigger was happening. Hedge funds weren't just repositioning. They were panic selling at the fastest pace in 13 years. That's not my estimate. That's straight from Goldman Sachs, who runs what's called a prime brokerage desk, meaning they literally have a front row seat to every major fund's trades on Wall Street. Their data showed Q1 hedge fund selling in North America was the largest since April 2020. Gross leverage was sitting over 300%, near an all-time high. And short exposure to macro ETFs like SPY and QQQ, the highest since the pandemic. Then, commodity analyst Rory Johnston said something that stopped the entire market cold. Every analyst I speak with, people that are not alarmists, people who make fun of alarmists, they're all terrified. We're talking $250 to $300 per barrel of Brent crude. Recession is too light a term. We're talking depressionary. That's the backdrop. Maximum fear, maximum short exposure. Everyone on Wall Street was betting one direction, down. Then, one Truth Social post changed everything, but not for the reason anyone told you. On the evening of April 7th, Donald Trump announced a ceasefire with Iran. And when markets opened the next morning, it was like someone flipped a switch. Over 400 names in the S&P finished green. 13 stocks printed all-time highs. Brent crude collapsed 13.5%. WTI oil was down over 16%, its biggest single-day drop since April 2020. But here's where the mainstream narrative completely falls apart. Maritime intelligence firm Windward, which uses AI to track GPS signals, satellite radar, and live ship imagery, detected only 5 outbound carriers moving through the strait by midday. That's a 96% drop from the pre-war baseline of 130 daily transits. So let me ask you a simple question. How do you have a relief rally celebrating peace when there's no actual peace? The answer? You don't. You have a short squeeze. When you short a stock, you borrow shares and sell them, betting the price drops so you can buy them back cheaper later and pocket the difference. But if the price goes up instead, you're forced to buy those shares back at a higher price. And if the price keeps rising, your broker issues a margin call. Close the position now or add cash.
When enough people get margin calls simultaneously, they all buy at the same time. That buying drives the price up, which triggers more margin calls, which triggers more buying. That's a short squeeze. And on April 8th, with macro short exposure at pandemic-era highs, the squeeze began. But that was only the first domino. Once stocks started ripping, the algorithms kicked in. CTAs, commodity trading advisors, are systematic trading firms that run on pure rules-based models. They don't read the news, they don't care about geopolitics, they just follow the trend. Trend down, short. Trend up, long. No emotion, no debate. Goldman reported CTAs were sitting on roughly $30 billion in net short positions going into the ceasefire. But the second the S&P crossed certain trigger levels, those models flipped. And they didn't flip to neutral, they flipped to aggressively long. Goldman originally estimated CTAs would buy back around $40 billion in equities to exit their shorts. The actual number? $86 billion, across just 5 trading sessions. According to Goldman's own records, that is a top 5 buying speed print of all time.
Then the third domino fell. Options dealers, the firms on the other side of your options trades, are required to stay delta neutral. That means when you pile into call options, they have to hedge by buying the actual underlying stock. Leading data platform Spot Gamma had flagged a negative gamma regime heading into the ceasefire. In plain English, when price moves up, dealers are forced to buy more stock to stay hedged, which pushes the price up more, which forces more buying. Short squeeze, CTA flip, dealer hedging. 3 dominoes, one after another. That's the rally. This isn't a bug. This is the new operating system of the American stock market. And here's the wild part. This isn't the first time we've watched this movie. December 2018. Stocks had been crashing for months on rate hike fears. Jerome Powell said one word on stage and the Dow gained over 1,000 points in a single session. The first time in history it had ever done that. August 2024. The Bank of Japan hiked rates for the first time in 17 years. The yen carry trade began unwinding. The Nikkei dropped 12% in a day, then bounced 10% the next. Different catalysts, same mechanical outcome, every single time. And the reason this keeps happening is that the market structure has fundamentally changed. 20 years ago, the market was dominated by human beings, portfolio managers reading earnings reports, analysts building models, people making deliberate decisions about what companies were actually worth. That market is basically gone. Today, 63% of all U.S. stock funds are held by passive indexers. Over $13 trillion of money that doesn't read a single earnings report. It just follows the index on autopilot. And because most passive funds are market cap weighted, the bigger a company gets, the more of it they buy. That's how the Magnificent Seven now make up over 33% of the entire S&P 500. A massive chunk of the market isn't being priced anymore. It's receiving allocation on default. The hedge fund industry has consolidated into a handful of giant multi-strategy mega funds running 4 to 8 times leverage with strict drawdown limits. When they hit a loss threshold, they don't call a meeting. They sell immediately. And underneath it all, same-day expiration options now make up over 63% of all SPX trading. On peak days, over $2 trillion in notional value changes hands in a single session. Every one of those contracts forces a dealer to hedge in real time, buying or selling the underlying stock to keep their books balanced. The dominant players in 2026 aren't analyzing valuations, they're reacting. And when they all react at the same time, their moves stack, and you get a market that rockets 3% on a ceasefire that nobody's actually honoring. Here's the truth that traditional financial media will never lead with. The stock market is no longer primarily a mechanism for pricing the value of businesses. It's a giant interconnected feedback loop, algorithms reacting to algorithms, passive funds allocating on autopilot, and options dealers hedging in real time. The headlines? Those are just the stories people tell themselves after the fact. And once you see that, once you understand the actual mechanics at work, you will never look at a market move the same way again. That's not cynicism. That's financial literacy. If this gave you something the nightly news didn't, hit subscribe, because this channel exists for one reason only. No dumbed-down narratives, no convenient omissions, just the real mechanics of how money actually moves. See you in the next one.